Alright everyone, welcome back to the channel. Today we're tackling a topic that causes a lot of worry for many small business owners and professionals in India. You're running your business, you're getting cash, you deposit it in the bank. And then you start wondering, will the income tax department ask me about every single deposit? Will they add it to my income and tax me again? Sounds familiar? It's a very common fear. And today we're going to break it down simply. Let's start with something helpful the government introduced for small taxpayers. We have these schemes called presumptive taxation. The most common ones you might have heard of are Section 44AD for small businesses, Section 44ADA for certain professionals, and Section 44A for owners of goods garages. Why were these brought in? To make life easier for people like you. These provisions help eligible assessees by simplifying compliance. Here's the main benefit. If you opt for these schemes and declare your income at a specified presumptive rate of profit like 8% or 6% in business, or 50% in certain professions, the law relaxes the requirement for you to maintain detailed books of accounts. This is a big relief, right? You don't have to keep ledgers, cash books, etc. in the strict way required otherwise. Now, think about this. You're doing cash business, you're depositing money. If you're in one of these schemes and haven't kept books, an issue can arise when you deposit cash in your bank account. During tax assessment, the officer might ask you to explain these deposits. But here's where the presumptive schemes help. In cases falling under Section 44AD or 44AE, because you don't need to maintain books of account, you're generally not obliged to explain every single individual deposit in your bank account, as long as the total amounts deposited during the year can be reasonably linked to your business receipts or turnover that you've declared under the presumptive scheme. The idea is, if the tax department accepts the turnover you've shown, they shouldn't ideally make further additions just because there are deposits that don't have a direct link to specific sales entries, especially when you don't have books. You can't be punished for not maintaining books by treating business receipts deposited in banks as unexplained. Okay? So, if you're under these sections and declared income correctly without maintaining books, they can't penalize you just for non-maintenance by treating your business deposits as unexplained. Let's quickly recap. Presumptive taxation means simpler compliance. Often no need for full books. If no books are maintained, explaining every single cash deposit from presumed business receipts isn't strictly required if it can be reasonably attributed to turnover. Now, can a tax officer still question cash deposits? Yes, they might try. This is where we need to understand a couple of sections. Section 68 and Section 69A. Let's break down Section 68 first. This section deals with unexplained cash credits. It says that if a sum is found credited in the books of account that the assessee maintains for any year, and if the assessee can't explain the nature and source of that credit, or their explanation isn't satisfactory to the tax officer, then that amount may be charged to income tax as the income of that year. Here are the key requirements or prerequisites for invoking Section 68. 1. Any sum is found credited. 2. It must be in the books of an assessee maintained. 3. The assessee offers no explanation or an unsatisfactory one. See that second point? It's absolutely essential, legally called sine qua non. Section 68 only applies if there are books of account maintained by the assessee. Existence of books is a condition precedent. You might have seen this happen in real life. What exactly counts as books of account? The law gives us a definition in Section 2(12)(a). It includes things like ledgers, day books, cash books, account books, basically, records you keep to track your business or finances, whether physical or electronic. This definition is inclusive. But here's the crucial point, something many court decisions have highlighted. Your bank passbook or bank statement is not considered a book of account maintained by you for the purpose of Section 68. Why does this happen? Because the bank passbook is just a copy of the bank's record of your account in their books. It reflects the bank's transaction with you as a customer, where the bank is the debtor and you are the creditor. It's not something you maintained, nor is the bank maintaining it as your agent or under your instructions. So, the courts have consistently said that a bank passbook supplied by the bank cannot be regarded as a book of the assessee or a book maintained by the assessee. For example, the Bombay High Court has upheld that a bank passbook does not constitute books as envisaged under Section 68. The credit must appear in the books of the assessee only, not any other person. Also, note that things like your balance sheet or profit and loss account are not considered books of account either. They're like summaries or byproducts. Similarly, just having loose sheets or papers isn't the same as maintaining books. Entries on loose sheets are often not treated as credit entries in books for Section 68 purposes. Proper books have specific objectives like recording business, calculating profit loss, helping file tax returns, showing financial position, assets, and liabilities. They aren't just secret diaries of transactions you want to hide. So, connecting this back, if you're under presumptive scheme like 44AD or 44AE and you have not maintained books of account, which is allowed under the scheme, the tax officer generally cannot invoke Section 68 based solely on the cash deposits shown in your bank passbook or statement. Because, as we just discussed, a bank statement isn't your book of account for Section 68 purposes. The condition precedent for Section 68, having books, isn't met if you don't maintain them. This is something most people get wrong. They panic about bank deposits, but if they are correctly filing under presumptive scheme without books, Section 68 based on the bank statement alone might not be applicable. We've seen courts and tribunals uphold this view repeatedly. For instance, if you declared income under 44AD without books, Section 68 shouldn't be invoked just for bank deposits. The Mumbai Itat has held that Section 68 cannot be invoked where income is filed under Section 44AD without maintaining books. Even a case involving a retired doctor showed an addition under Section 68 was deleted because credit in a bank account isn't the same as credit in books of account, and they weren't required to maintain books under Section 44A. Now, a quick point. What if you are required to maintain books? Maybe because your turnover was higher than the limit for the presumptive scheme and you didn't? The law says you cannot take advantage of your own mistake. Or what if you actually did maintain books, but just didn't produce them to the officer? In such cases, Section 68 could still apply. But if you genuinely don't maintain books because you're covered by a presumptive scheme and meet its conditions, that's a different story for Section 68. Okay, so if Section 68 might not apply based solely on bank deposits for presumptive filers without books, can the officer do anything else? Yes. The officer could potentially look at the deposits under Section 69A, which deals with unexplained money. However, even here, the sources indicate that the tax officer can resort to Section 69 for bank deposits only if they have some material or evidence to show that these deposited amounts are not related to your business, which is covered under Section 44AD or 44A. In other words, the officer first has to take the deposits out of the ambit of your declared presumptive business before making an addition under Section 69A. If the deposits do relate to your presumptive business and your declared income covers the presumptive rate on the corresponding turnover, then additions based on these deposits alone are difficult. Let's quickly recap. Section 68 needs books. Bank statement, not a book. Section 69 is for unexplained money. But for presumptive filers, the officer needs evidence the deposit isn't business related and falls outside the presumptive scheme. What about situations where the cash deposits are clearly not related to any business you're doing, or maybe you don't even have a business? This is a different scenario. In such cases, the officer can certainly ask for explanations for unexplained cash deposits. How can you explain such deposits? People commonly offer a few types of explanations. 1. The cash came from past savings or accumulated funds from earlier years. This could be from old taxed income, tax-exempt income like agricultural income, or retirement benefits that you saved up. 2. The cash came from amounts you had withdrawn earlier from the same bank account or other bank accounts. 3. If there are lots of deposits and withdrawals, you might argue that only the peak balance at any point in time should be questioned, not the total of all deposits. Let's take a moment here to think about the first 2 points. If you claim cash deposits are from past savings or earlier withdrawals, you need to back this up with sufficient evidence to establish the source of funds in earlier years. For past savings, you can show earlier tax returns or details of income like retirement benefits. Your explanation deserves acceptance and shouldn't be simply rejected based on suspicion or speculation that you must have spent that old money. If you say the cash came from earlier withdrawals, this is a very common explanation. If you withdrew cash and later deposited it back, the tax department generally can't just disbelieve you based on a guess that you must have used that money elsewhere. In the absence of any evidence that the sum was used in another manner, they wouldn't be justified in rejecting a good explanation. They would need to bring material on record to prove that your earlier withdrawals were used for something else. The onus or burden of proof to show the withdrawal wasn't available rests on the revenue, the tax department, not entirely on you. Here's a quick point. There's no law that says you can't keep a certain amount of cash at home, or that you must deposit money back into the bank immediately after withdrawing it. You could plausibly say you withdrew it for something that didn't materialize, like buying property. While a very long or unusual time gap between withdrawing and depositing might look suspicious and be viewed unfavorably, the conclusion depends on the specific facts of each case and the evidence you provide. We saw an example where someone withdrew a large amount but continued smaller withdrawals later, and the officer questioned why the large sum was held for months, using arguments about human probability, losing interest, and risk. The officer even relied on a Supreme Court judgment Sumti Dayal v. CIT related to human probability. The CIT in that example also felt it was against human probability, but ultimately, successfully explaining it depends on the evidence. Now, let's talk about the peak credit concept. This usually comes up when you have a series of unexplained cash deposits and withdrawals in one or multiple bank accounts, and maybe these aren't clearly linked to business, or there's no business at all. Instead of taxing the total of all deposits, which can be misleading if the same money is just going in and out, the tax officer might calculate the highest unexplained balance that existed in the accounts at any point during the year. This highest point is called the peak credit. This approach is accepted by courts and tribunals and makes sense because you shouldn't be taxed multiple times on the same money flowing in and out if its source isn't explained. This is sometimes coupled with telescoping, where unexplained cash credits are set off against other separately taxed undisclosed income. The application of peak credit removes the cascading effect where earlier deposits get subsumed by later, bigger balances. The addition of only the peak balance has been upheld in cases where there's no business nexus or no business at all. Even in a 44 AD case where total deposits exceeded declared receipts, the tribunal applied the peak credit concept, treating the difference as suppressed sales, but allowing credit for withdrawals used for purchases. Let's look at a couple of specific situations mentioned. What about cash deposited in a joint bank account? If the account and the income from it, like interest, are fully disclosed and accounted for by the other joint holder, say your father, in their tax return, then the cash deposits might not be added to your income, especially if you can show the funds belong to them. An addition in your hands might not be justified without proof to the contrary. This was seen in the Alok Keshwani case, where deposits in a joint account were not added in the assessee's hands as the father had disclosed the account and interest. However, if you claim the account belongs to someone else, like a grandfather, but you can't prove that person had enough substantial income to make those huge deposits, then the addition could end up being made in your hands. This happened in the Praveen Kumar case. Finally, imagine an undisclosed bank account is found during a search. Cash deposits are regular, and you say they are from unrecorded sales. You might even have details of these unrecorded sales and stock. Can the entire deposit amount be added as unexplained money under Section 68 or 69A? The key principle here is that income tax is on income, not on every single receipt. If you can demonstrate that the amounts deposited represent your gross receipts, like unrecorded sales, then generally, only the profit element from those sales should be taxed, not the entire deposit amount. The profit might be estimated on the basis of the material on record, perhaps around the 8% level, like the presumption in Section 44 AD, or even lower depending on the facts and nature of business, as seen in some court cases mentioned. So, to quickly summarize the key takeaways. Presumptive schemes like 44 AD Ada AE allow you to avoid maintaining detailed books if you declare specified income. Section 68, Unexplained Cash Credit, requires the credit to be in the assessee's books of account. A bank passbook or statement is not considered a book of account maintained by the assessee for Section 68. Therefore, if you haven't maintained books under presumptive scheme, Section 68 often cannot be invoked based solely on bank deposits. The officer might look at Section 69 for unexplained money, but for presumptive filers, they need material to show the deposit is unrelated to the declared business. If deposits are unrelated to business, you can explain them with past savings or earlier withdrawals, provided you have sufficient evidence. The onus to disprove withdrawals is often on the revenue. For a series of unexplained deposits withdrawals, the peak credit concept might apply, taxing only the highest unexplained balance, especially if there's no business nexus. In undisclosed accounts from a search with unrecorded sales, generally only the profit element is taxed, not the full deposit amount. Now you know what most people don't. Understanding these concepts can really help you navigate potential questions from the tax department. If it's still confusing, listen to this part again. And if you found this helpful, please share this with someone who needs to know. That's it for today. Stay informed, stay compliant. See you in the next video.